Well, welcome back from your break. I'm still your host, Dr. B. Happy to have you back. Let's talk about this concept called flexible budgets, and then we'll talk about another concept called standard cost. Along the theme with budgeting, it's it's important to have some flexibility in your budgets. And the reason for that is things change in business. Your sales might not be as you expected it to be for the month. Your expenses might be a little off. So we need to be flexible in our budgeting. That's what the word flexible means. We need to be able to adjust accordingly. That's the concept behind having a flexible budget. Uh, there's two types of budgeting, really. There's two models of budgeting. One's called a flexible budget, and the other is called a static budget. A static budget is a budget that does not change, regardless of the level of output. A static budget is a budget that does not change, regardless of the level of output. Examples of who uses a static budget? The government. The government agencies, whether it be state, local, federal, whatever, they use static budgets. Their budgets are set in stone for the year. Okay? They don't change, regardless of how much you use or don't use. The budget's the same. Okay? That's called a static budget. It does not change the level of output. A dynamic or a flexible budget is the other type of budget, and those do change with the level of output. You can adjust the budget up or down. That's what makes it flexible. And we do that through kind of like a tier process or a percentage based process. It's based off of our performance. And so I'm going to show you what all that looks like. So uh, through the master budgeting process that we just talked about, where we create the sales budget and then the production budget, which leads into the direct materials budget, direct labor budget, the factory overhead budget, which then, of course, goes down to selling administrative budget, capital expenditures budget, and ultimately the cash budget. That's the master budgeting process that we just talked about in the previous chapter. We take that approach, that concept of the master budget, and we select one or the other budgeting approaches. One's called a fixed or static budget that does not change with the level of output. Budget just stays the same, yeah? Or we use what's called the flexible budget, and it's based off of different sales levels, level of output, right? So a fixed budget does not change regardless of the level of output. The flexible budget changes with the level of output. Level of output, of course, being sales. A fixed budget or a static budget, it's fixed. I cannot change it. Okay. Government agencies are notorious for using the fixed budget approach. Okay. Some nonprofits also use a fixed budget approach. Some companies even use it. I don't always recommend it. And let me show you why. This is an example of a fixed budget. The budget is sales, budgeted cost of goods sold, budgeted materials, direct labor, factory overhead. I budgeted for my selling administrative expenses, etc. Right? On the left column, we see the fixed budget amounts. As I had said, we cannot change the budgeted amounts. It's fixed. Okay? They don't change with the level of output. So I projected my sales budget of 10,000 units. That's 100,000 in sales dollars. I had a direct materials budget of 10,000, direct labor of 15,000. I had a bunch of overhead budgeted out, selling administrative expenses, and so on. The fixed budget, you cannot change the budget. It's fixed. So at the end of each accounting period, whether it be a month or a quarter or half a year, you compare the budgeted amount to the actual results. Okay? You'll notice differences. We call these differences a variance. A variance is the difference. That's what the word variance means. It means difference. Just another way of saying difference. A variance is the difference between the actual results and the budgeted amount. To find the variance, we take the actual results minus the budgeted amount. The variance, we take the actual results minus the budgeted amount. Take a look at this. Sales. I budgeted for 10,000 units. I actually sold 12,000. That's a good thing, right? I sold more than I budgeted for. That's a great thing, okay? I sold $125,000 worth. Budgeted for 100,000. That gives me a favorable variance of 25,000. Actual minus budget. $25,000 favorable variance. The reason why it's favorable is because it's good for the business. They have more sales than what you budgeted for. Yeah, that's favorable. I got more coming in than I projected. Favorable. But let's take a look at everything else. Budgeted direct materials. I budgeted for 10,000. I actually spent 13,000. It's unfavorable. The reason why it's unfavorable for expenses to be greater than the budgeted amount is because we went over the budget in expenses. Okay, your projected expenses. That's not a good thing to go over on expenses. So therefore, it is unfavorable. When your actual results are greater than your budget and it is an expense or a cost, that is unfavorable. Right? That makes sense. If I'm spending more than I projected I was going to spend, that's unfavorable. Very straightforward. So remember, to find your variance, take your actual results minus your budgeted amount. Now we total everything up. Okay, let's total everything up. I have 25,000 variance favorable. I received more than I budgeted. That's a good thing. Right. Cash coming in more than what I expected. That's a good thing. That's favorable. This example, 25,000 actual minus budget. So my 25,000 variance, and then I got all these unfavorables. That's because I spent more than I expected. 3,000, 5,000, 100, 1,000, 1,800, 300, 200, 200. So what I do is I total up all my expenses, my variances. My total expense variance is $11,600. Unfavorable. It's unfavorable again because I spent more than I had planned for. I take my sales minus my total expenses to give me my income from operations. My income from operations is $3,400 variance. It's favorable. Okay. The reason why the income from operations is favorable is because the sales variance was greater than the expense variance. Put it simply. Make sense?
Yes.
Awesome. Thank you, Tia. I mentioned that in business, it's kind of important to be flexible, right? Especially with budgeting. The reason for this is because you might project more or less in terms of sales and or expenses. And when that happens, you want to be able to adjust. Okay, you want to be able to adjust your expenses to match your revenues, right? To keep things in line, keep things in order. So we can prepare a budget that is flexible based off of the operations. I can do that through what we call levels of activity. I can predict sales, right? 100%, 110%, 120%. Or I can do 80, 100, 120, or whatever. It's based off of the level of activity. So that's what the concept of flexible budgeting is. So let me show you an example of this. After we go through fixed and variable cost, I'm going to show you an example of a flexible budget. So flexible budget provides flexibility in a couple of different ways. Of course, it's based off of the level of activity. As you know, the total variable costs change in proportion to the level of activity. The more units I sell, the more variable cost I have. That makes sense, right? Because direct materials, direct labor, factory overhead, direct materials, direct labor are variable costs, right? The more I sell, the more I manufacture, the more variable cost I have. And fixed costs, as you know, remain the same over time, regardless of the level of output. The flexible budget, I can budget based off of the sales amounts. We do this in what we call tiers, okay, or you could even do a percentage based. Let's say I expected to sell $120,000 worth, or 12,000 units. That's great. But what if I sell less than that? So we could say, oh, well, we could budget if we sold 10,000 units, or we could budget if we sold 14,000 units. What this does is it allows for my variable costs to be flexible to budget, right? So it helps a lot to do this because this allows for variation. It allows for the business to be flexible. So let's take a look. I sell 10,000 units. That means I'll sell $100,000 worth. I have my direct materials, direct labor, factory overhead. Then I have my selling administrative expenses. So give me my total variable cost. Total variable cost, 48,000 if I sell 10,000 units. This gives me a contribution margin of 52,000. Remember, we find contribution margin from taking your sales minus your variable cost. I have my fixed cost. Fixed costs don't change. It doesn't matter whether you sell 1,000 units or 100,000 units. Variable cost is going to be the same. That's things like depreciation, supervisor salaries, insurance, depreciation, administrative expenses, utility, not rent. You know what I'm talking about. Those are the fixed costs. They don't change regardless of the level of output. So contribution margin minus your total fixed costs equals your income from operations. We do this for the three different levels of sales. If I sell 10,000 units or 12,000 or 14,000, I do that for each level. That provides flexibility. That's the whole idea behind it. Just as I did with um, my static budget or fixed budget, I need to find my variances. And when I find my variances, you'll notice that my variances are a lot more close to the flexible budget amount. Let's take a look at this. Because I'm using a flexible budget, I can adjust that budget based off of my actual performance. I budgeted for 10,000 units, 12,000 units, and 14,000 units, right? I sold 12. Great. I have a budgeted column for that. So my sales, 12,000 units, I expected to come in at 120,000. I actually came in at 125,000. Great. I don't know why that happened. Maybe I sold it for a little bit more than I normally do. I raised my sale price for whatever reason. So fantastic. I have a variance of $5,000. It's favorable. Remember, favorable means that we got more coming in than we expected. It's favorable. For sales, that is. It's unfavorable if your actual costs or expenses are greater than your budgeted amount. So we see direct materials and direct labor. We have an unfavorable variance there because I spent more than what I planned for. Now take a look at factory supplies, shipping expenses, and office supplies. We see that those are favorable. Now the reason why is the actual amount came in, the actual expense came in less than the budgeted amount. When you come in under on your expenses or your costs, that's a good thing. You didn't spend as much as you planned on those expenses. That's a good thing. You save the company some money. So that's favorable. That's the way to think about it. Huh? Remember, it's actual minus budget. Actual minus budget. That gives you the variance. We see our contribution margins favorable because, remember, contribution margin, that's your sales minus your variable costs. We want a higher contribution margin. We got a higher one. So $3,200 variance for a contribution margin, favorable. Total fixed costs, a little on unfavorable side, not by much though. So we take sales minus variable costs equals contribution margin minus fixed costs equals income from operations. We have a $3,000 favorable variance for income from operations based off of the flexible budget. That's awesome, right? That's a good thing. But you see how close the budget is to the actual results. That's what you want in business. You want to be as close as possible. Any questions on budgeting? Flexible, fixed? Questions on variances, how to compute variances? You're all good. Okay. All right. It's a good thing. It's a good thing. I want to talk to you about cost a little bit more than what we have been the past few weeks. Costs are really important to understand when we budget. The reason for that is because we need to know how much to budget for in terms of direct materials, direct labor, factory overhead, based off of the production budget, of course. Costs come in a big play here, okay? These also help us to better understand why we have variances in things like direct materials, direct labor, and factory overhead. Look at what we call standard costs. The way I want you to think about a standard cost is a standard cost is the cost I expect. It's my budgeted cost. That's how I want you to think about standard cost. The standard cost is the budgeted cost, or what the cost I would normally pay. Your standard cost, think budgeted or the cost I would normally pay. These are the costs that would be under normal conditions. These costs are established by, accounting, past experiences, blah, blah, blah. It's the expected level of performance. This is the cost that I would expect to pay. This is my normal cost. This is my standard cost. This is my normal cost. This is my budgeted cost. This is what I would normally pay, my standard cost. We use standard costs for direct materials, direct labor, and factory overhead. Now, how do we set standard costs? Well, it's relatively simple. For materials, we take the standard price. We multiply that by the standard quantity. I normally pay $20 per pound of wood when I make my hockey sticks. Yeah. That's my normal price for a pound of wood is 20 bucks. So 20 pounds of wood. I normally buy 3,000 pounds of wood per quarter. So I take the 20 times the 3,000. That gives me my standard direct materials cost. This is what I normally pay. $20 per pound of wood. I normally buy 3,000 pounds. That's my standard direct materials cost. Direct labor. It's the rate times the standard time. Standard rate times standard time. I normally pay my employees $12 an hour. They normally take a quarter of an hour to produce a single hockey stick. $12 times a quarter. 0.25. That gives me my standard direct labor cost. And then I have my variable overhead. It's my standard overhead rate times the standard activity, which could be expressed in terms of hours or whatever. So my standard variable overhead is $2.50 per hockey stick. We have a company. This is our example that we're going to use for this time. We have a company that produces baseball bats. Oh, I like baseball. It's one of my favorite sports. Our company produces baseball bats. Okay? Our name of our company is called ProBat. That's nice. But we make baseball bats. Here's some information. This is what we call our standard cost card. Between direct materials, direct labor, and factory overhead. I normally buy 1 kilogram of wood. It costs $25 per kilogram, giving me a standard materials cost of $25. Okay. It normally takes employees 2 hours. They get paid $20 per hour. My direct labor, my normal direct labor is $40. The overhead. It normally takes 2 hours, and it's based off of labor. My overhead rate is $10 per hour, giving me an overhead per unit of $20. Standard, it's what it normally is. My normal direct materials is $25 per unit. My normal direct labor is $40 per unit. My normal overhead is $20 per unit. They add up direct materials plus direct labor plus factory overhead, giving me a normal cost of $85 per baseball bat. Now let's compute the variances. As we discussed, a variance is the difference between the actual and standard cost. That's what the word variance means. It means difference. If the actual cost is greater than the standard cost, it's unfavorable. Makes sense. If my actual comes in greater than my standard or my budgeted, it's unfavorable. If the actual cost is less than the standard cost, that's good. That's favorable. It saves the company some money. Favorable. Why do we look at variances in the first place? Well, they help us to better understand the business. They help us to optimize our performance, and they help us to better improve the overall business. So what I do is I prepare my variance reports, I analyze them, I conference about them, and then I take action. I'll make a decision. Variances involve this process. Compute and analyze difference, identify and answer any questions, and take a corrective action if we have to. If it's a really good variance. How do we compute a variance? Well, it's relatively straightforward. We take the actual cost minus the standard cost. Pretty straightforward. Absolutely. It's a little bit more detailed than that, of course. To find the actual cost, we take the actual quantity times the actual price. To find actual cost, we take the actual quantity times the actual price. And you already know how to find standard cost. We take the standard quantity times the standard price. So we take the actual cost minus standard cost to find the cost variance. This is the general formula that we use. So remember, we find the variances for both direct materials and direct labor. For direct materials, it's the actual quantity of materials. For direct labor, it's the actual hours. So just keep that in mind. For materials and labor, there are two primary factors that causes a variance. It's usually a difference in price and or a difference in quantity. Yeah, absolutely. It's either going to be a difference in price or a difference in quantity that's going to cause the variance. Materials and labor, very normal. So we need to figure out the difference in the variance in price and the difference in the quantity. To find a difference in price, we take the actual cost, which is actual quantity times actual price. The actual cost minus the actual quantity times the standard price. Say that again. The price variance, we take the actual cost, which is the actual quantity times the actual price, minus the actual quantity times the standard price. This shows me the price variance. Basically shows me the difference between the actual price and the standard price. You just plug the numbers in, yeah? Very easy. So that's how to find the price variance. To find the quantity variance, which is the difference in quantity, we take the actual quantity times the standard price. I actually bought times the standard price minus standard quantity times the standard price. This shows me the variance in quantity, the difference in quantity. Basically, all I'm doing is I'm taking the actual quantity minus the standard quantity. That shows me the variance. Yeah? But that, remember, you just plug the values in to make it easy. But the difference between the actual cost and the standard cost gives me the cost variance. This slide's a little complex. Prefer the one that we just saw. But I'm going to show you how it all comes together. Standard quantity is the quantity that we should have used, right? That's why we call it standard. It's the normal. It's the average. It's what we normally do, the standard. Standard quantity is the quantity that we should have used for the actual production of the product. If I'm making a baseball bat, it normally takes me 2 hours of labor. Yeah. So 2 hours is my actual hours, or I'm sorry, my standard hours. It normally takes me 2 hours to make a baseball bat. So 2 hours is my standard quantity for labor. The standard price is the amount that I should have paid for those resources. I normally pay my employees $20 per hour. So my standard price for labor is $20 per hour. The actual, of course, what I actually pay per hour and what the actual number of hours worked on each baseball bat. So the actual cost is the actual quantity times the actual price. To find the price variance, we take the actual quantity times the actual price minus the actual quantity times the standard price. It gives me the price variance. Standard cost or standard quantity times standard price. To find a quantity variance, we take the actual quantity times the standard price minus the standard quantity times the standard price. Actually, I'm just repeating what you already know. Let's take a look at our example. Here we have another company, yet a third company. Now we're making golf clubs, right? Instead of baseball bats, now we're doing golf clubs. That's fine, whatever. Make a golf club. We have materials and labor. Direct materials. It takes us half a pound of aluminum, $20 per pound. A pound at $20 per pound is $10. Direct materials, that's my standard price for materials, $10 per golf club. Half a pound, $20 per pound is $10, my standard price, my normal price. For the labor, it takes me 1 hour to make a golf club. I pay my employee $16 per hour. So 1 hour times 16 is $16 for direct labor. Direct materials plus direct labor gives me a standard direct cost per unit of $26. We know there's overhead, but we're only talking about materials and labor for right now. So, direct materials, again, I normally use half a pound of aluminum at $20 per pound, is 10. It usually takes me an hour per golf club at $16 per hour, that's 16. Total per golf club is 26. Now we purchase. Okay, during the month of May, we made 3,500 golf clubs. We used 1,800 pounds of material to do it. We paid our employees we paid for the month of May $21 per pound of material. At the time, the price of aluminum was a little bit high. So let's compute the variance. So remember, looking at the information, I normally, standard cost, pay $20 per pound. This is saying I pay $21 per pound because the price of aluminum went up. Let's compute the variance for the materials. Purchased 3,500 pounds. It takes me half a pound per golf club. That's 1,750 pounds. I normally pay, standard price, normally pay $20 per pound. So my standard cost should have been $35,000. Great. What actually happened? Well, my actual quantity, I was a little over. I ended up using 1,800 pounds. 50 pounds of waste went somewhere. Times an actual price that I paid of $21 per pound. That gave me an actual cost of $37,800. Now let's find the price variance and quantity variance. Price variance, $1,800 unfavorable. Unfavorable because my actual was greater than my standard. Right? My quantity variance was $1,000 unfavorable. Why? Because my actual quantity was greater than my standard quantity. This gives me a total direct materials variance of $2,800 unfavorable. Price plus quantity variance gives you total direct materials variance. So what happened? Who's responsible for it? Who's in trouble because the price went up? It depends, right? Why did the price go up per pound? Well, we use a certain aluminum. We could maybe use a different type of aluminum, et cetera, et cetera. Why the variance in labor? Well, we were overpaying our employees. We could have leveraged our equipment, et cetera, et cetera. This goes back to the process of understanding why the variances happened in the first place. What about labor variances? Labor variances, as you recall, actual cost minus standard gives you the variance. When we look at labor, there are two variances that we look for. There's the rate variance, that's the difference in the per hour rate that we pay our employees. That's a rate variance. And there's an efficiency variance. This tells us the amount of time that they're using to produce a single unit. That's what efficiency variance is. So again, to find your actual cost, actual hours times actual rate. To find your standard cost, standard hours times standard rate. And we use actual hours times standard rate to find the variances. Let's take a look at our example. In the month of May, we produced 3,500 golf clubs, working 3,400 hours. We paid our employees an average of $16.50 per hour. Remember that our standard cost, standard labor is, I could do 1 unit per hour at $16 per hour. I can already tell you that based off of this information, I'm over on my labor per hour, 16 compared to 16 and a half. I'm under on my efficiency. Let's take a look. The standard, 3,500 hours, $16 per hour, 56,000. My actual, 3,400 hours used at $16.50 an hour, giving me an actual cost of $56,100. Variance calculation. Actual hours 3,400, standard cost $16. Give me 54,400. You can see that our rate variance is 1,700 unfavorable, which I expected because we paid 50 cents more per hour. Efficiency variance is favorable by 1,600. I also expected because it normally takes us 3,500 hours, we only use 3,400 hours. So we use 100 hours less. This gives us $100 total cost variance. Unfavorable, of course. So why are there differences or variances in labor? It depends on skill. High skills, low rates. I'm sorry, low skills, low rates. High skills, high rates. Everything in between. It's one of the many reasons for labor variances. Who's responsible for the variance? It depends on who you talk to. It could either be the engineers or HR. The last variance we need to talk about, of course, is overhead. Overhead, we typically use the predetermined overhead rate or single wide plant rate method. This is assigned to products and services using the predetermined overhead rate. It's usually based off of total overhead cost divided by an estimated activity, like labor hours, for example. To find the assigned overhead, we take the predetermined overhead rate times the standard activity, labor hours, or something like that. And then we find the standard overhead rate to apply. So first, we figure out the allocation base, choose a predetermined activity level, and we compute the standard overhead rate. Flexible budgeting, we do this based on the number of units we expect to produce. total variable cost, total fixed cost, giving us our total factory overhead. Total factory overhead divided by this direct labor hours gives us the predetermined overhead rate. We can do that based off of capacity in this example. Capacity is our metric here. Predict 80%. We'll take total factory overhead divided by the direct labor hours, giving us $2 per hour of factory overhead. Okay, so there's a variance for overhead. To compute that variance, we take the actual overhead incurred minus the standard overhead applied. Our example, we take the actual overhead incurred minus the standard overhead applied. The actual overhead incurred was variable of $3,650 plus fixed $4,000. Our standard overhead applied was $2 per labor hour times number of labor hours, 3,500. That's the standard. Actual overhead incurred was 7,650 minus the standard overhead applied of 7,000. This gives me an unfavorable variance of 650. Actual minus standard gives you the variance. Okay, and of course, when there are variances, we need to adjust for those. Too deep in that one. Okay. And when there's changes in sales, we expect there to be what we call sales variance. And you can compute sales variances very similarly to the way that we did with everything else. Actual minus budgeted. Actual minus budgeted. Actual sales times actual price. Minus the budgeted sales times budgeted price, etc. It's the same exact process. And we could look at the overhead variances from this perspective of variable overhead and fixed overhead. And there's variances for both variable and fixed overhead. This is an example of that. And looking at this example, we can see, that the calculations are really the same. The basic formula, you can run all kinds of variances. Of course, we can graph out the variances as well. That's what this shows us. This chart kind of summarizes the various variances, just to kind of put things in perspective and have it all in one or two slides makes it helpful. Now, when there are variances, there are a couple of journal entries that we have to make at the end of the accounting period. Just as we normally would with any adjusting journal entries, we have to adjust. We have to make journal entries for those variances. And in this example, we debit work in process inventory, debit direct materials variance, debit direct materials quantity variance, and then credit raw materials inventory. And what this does is it applies the actual cost based off of the standard cost. We do those adjusting journal entries for all variances at the end of each month. Any comments, questions, concerns about flexible budgets or standard costs? Anything at all? Comments, questions, concerns? It's a lot of information to consume at one time. Good. Still awake? Okay, got a lot of notes. Yeah, I can imagine, Tia, for sure. Okay, let me quickly show you where we are in the classroom, just to remind you. We are in Module 3, Week 5. For this Sunday night, you have your Chapter 22 homework assignment on budgeting, and your Chapter 23 quiz, which is on flexible budgets and standard costs, with cost variances. As always, you have 2 attempts. Take the higher of the 2 attempts, about 5 questions, mixed, true, false, multiple choice, etc. If you have any comments, questions, or concerns, if you need help with anything, you can always email me, call me, set up office hours. Whatever you need, I'm always here for you. With that, if there are no other questions, I would like to remind you all to please stay safe, wash your hands, do the right things, and I'll see you all again next Tuesday. Thank you so much for your time today. I appreciate all of you. Have a wonderful rest of your day.